Welcome to the Deep Dive. Today, uh, we're shifting gears a bit, focusing on something foundational. We're drilling down into the work Warren Buffett famously called, well, by far, the best book on investing ever written, Benjamin Graham's The Intelligent Investor. If you look at your portfolio and feel that rush when things go up, but then maybe sheer panic when they drop, this deep dive is definitely for you. We're pulling out the core, actionable stuff from Graham's work. It's like an antidote to all that market anxiety. His framework, it's not about finding the next big thing overnight. It's about building wealth steadily, long-term, through discipline, real analysis, and maybe the hardest part, emotional control. So our mission today, to really distill those essential principles that make someone an intelligent investor and show you how you can actually apply them no matter what the market's doing tomorrow.
Yeah, it's a vital mission, I think, because Graham isn't just giving you tactics, he's offering a whole mindset, a philosophy. And that philosophy, it kicks off by separating two things the financial world loves to blur together.
Okay, right. Let's unpack that. Graham starts with this really fundamental concept, the huge difference between investment and speculation. Why is drawing that line so important right at the beginning?
Well, because if you don't, it's incredibly easy to fool yourself. You think you're investing, but actually you're just gambling. Graham gives us a really crisp definition for investment. He says it's an operation that, after thorough analysis, promises safety of your principal and an adequate return.
So, okay, if you skip the analysis part, or if keeping your initial money safe is kind of iffy, or the return depends purely on, like, getting lucky.
Then yeah, by his definition, that's speculation. Simple as that. And what's really interesting here is how the focus changes completely between the two. The intelligent investor, their analysis looks inward. They're calculating the intrinsic value of the actual business. They're looking at assets, earnings, the debt load, real stuff.
Yeah.
The speculator, though, they're looking completely outward. They're betting purely on price movements. They don't really care what the company's worth deep down. They care what the next person might pay for the stock tomorrow or next week. That difference, it's everything. It determines if you're acting like an owner or just making a bet.
Yeah, and it sounds straightforward, but let's be honest, in the real world, that speculative noise is just deafening, isn't it?
Yeah.
Every news headline, every social media trend, it feels like it's pulling you towards speculating. How does Graham suggest we kind of insulate ourselves from all that?
Well, he gives us this absolutely brilliant allegory. One of the best in finance, really. The character he calls Mr. Market.
Okay, tell us about Mr. Market.
Right. So imagine Mr. Market is your business partner, but he's, let's say, extremely emotional, maybe manic depressive. He's a partner in every single stock you own, and he shows up at your door every single day.
Every day.
Every day. And he offers either to buy your share of the business from you or sell you his share and the price he quotes. It's based entirely on how he feels that particular day.
And his moods are pretty wild, I take it.
Oh, legendary. Some days he's just euphoric, absolutely convinced the business is the greatest thing ever, future's incredibly bright. He'll offer you a ridiculously high price for your shares.
Okay.
Other days, though, he's completely consumed by despair. Totally irrational pessimism, convinced the company's doomed, going bankrupt tomorrow. And on those days, he's desperate to sell his shares to you for, pennies on the dollar. And here's the absolute core insight for you, the listener. This is what separates the intelligent investor from, well, everyone else reacting emotionally. You are under no obligation whatsoever to trade with Mr. Market. He's there to serve you, not to guide you, his emotional state. It's totally irrelevant to the actual underlying value of the business you partly own. So the intelligent investor learns to use Mr. Market's moods to their advantage, actually. They see that when he's pessimistic, offering really low prices for good businesses, that's a buying opportunity, a fantastic one sometimes.
Right.
And when he's overly optimistic, quoting sky-high prices, well, that might be a time to consider selling, or at the very least, just hold steady, be patient. The absolute key is never, ever let his psychological swings dictate your own analysis or your investment decisions.
That just reframes the whole thing, doesn't it? The calmness you get from basically ignoring Mr. Market's daily drama is directly tied to managing risk. If you don't feel forced to buy when he's ecstatic and prices are high, you avoid the biggest risk of all, overpaying. And that leads us straight into what Graham saw as the ultimate protection against all this uncertainty, the absolute core principle of value investing. So once we get our heads around Mr. Market being, well, kind of crazy, the next question is obvious. How do we protect ourselves when the market is behaving like that? This is where we have to talk about the margin of safety.
It really is the cornerstone, yeah. Graham saw it as essentially the only truly dependable way to ensure both things we mentioned earlier, safety of your principal and getting an adequate return.
Okay, define it simply for us again. What is the margin of safety?
It's actually quite straightforward. The margin of safety is just the difference between the intrinsic value of a stock, that's what your analysis tells you the business is really worth, and the price you actually pay for it, which needs to be significantly lower.
Goal being.
The classic goal, the one everyone loves to quote. Buying a dollar's worth of business for 50 cents, or maybe 60 cents, some significant discount anyway.
But hang on, if calculating that intrinsic value was easy, wouldn't everyone just do it perfectly and get rich? What makes figuring out that real worth so tricky, even for pros?
That's a really good point. The challenge is, calculating intrinsic value isn't like solving a math problem with one right answer. It's fundamentally an estimate. It's based on projecting future earnings, future cash flows, thinking about the broader economy, things you can't know for sure. There's no perfect formula. You will make mistakes in your judgments sometimes. You can't perfectly predict the next recession or some unforeseen event hitting the company. And connecting this back, that inherent uncertainty is exactly why the margin of safety is so absolutely critical. It builds in this buffer, this cushion, against those unavoidable errors in your analysis or unexpected bad news or sometimes just plain old bad luck.
Yeah.
If you manage to pay 50 cents for something you think is worth $1, the business can actually underperform your expectations quite a bit, and you still probably won't suffer a permanent loss of your capital. The wider that margin, the less you're relying on everything going perfectly right.
It's so practical, isn't it? Graham's wisdom here isn't about trying to shoot the moon and maximize every last penny of potential upside. It's laser focused on minimizing the chance of losing your money in the first place. It's like buying insurance against the messy reality of business and, well, Mr. Market's mood swings.
Exactly right. And that whole mindset, that defensive posture almost, leads nicely into the next piece. Graham knew that not everyone has the time or maybe the skill or even just the temperament to be doing deep intrinsic value calculations all day.
Yeah, I really appreciate that about Graham. He wasn't this ivory tower academic saying my way or the highway. He recognized people are different. Some have tons of time for research. Others just need a reliable, straightforward system. So he broke investors down into two main types based on how much time and effort they can realistically commit.
Yeah, let's start with the defensive investor. This is probably most people, really. This is the person who mainly wants to avoid big mistakes. They value convenience. They want a stable, reliable portfolio that doesn't require constant tinkering. You know, the classic buy and hold approach.
Their main goal isn't necessarily to beat the market every year, right? It's more about preservation.
Exactly. Preservation and achieving reliable, steady returns over the long haul. They're not trying to squeeze out an extra 5% alpha each year.
And for this defensive type, Graham gave some pretty specific, actionable rules, didn't he?
Yeah.
Which are still incredibly useful for someone building a conservative portfolio today.
Oh, absolutely. Very concrete. His main advice often included keeping a diversified portfolio. The classic suggestion was something like a 50-50 split between a broad basket of stocks and high-quality investment-grade bonds, and periodically rebalancing that mix to keep the risk in check.
Okay, but what about the stock part? Any specific rules there?
Yes, very strict criteria for the stocks a defensive investor should own. First, they need to be large, prominent companies, household names often, and crucially, conservatively financed.
What did he mean by conservatively financed? Low debt?
Pretty much, yeah. Graham was very wary of companies carrying too much debt. He wanted businesses where equity significantly outweighed debt. Companies that could survive tough economic times because they weren't drowning in interest payments.
Makes sense.
What else? He also insisted on a long history of stable earnings and, importantly, continuous dividend payments for many years. 20 years was a number he often mentioned. That history, it speaks to the durability and resilience of the business model.
Okay.
And even for the defensive investor, the stocks must be bought at a reasonable price. He wasn't saying buy good companies at any price. He looked at things like the price-to-earnings ratio, the PE ratio, demanding that it be fairly low compared to the company's own history and maybe its industry peers. So even here, there's a form of margin of safety, making sure you don't overpay, even for quality.
Got it. Okay, so that's the defensive investor. Then you've got the other side of the coin, the enterprising investor. Who's that?
Right, the enterprising investor. This is someone who is willing and, importantly, able to put in significantly more time and intellectual effort. They're doing deep research on individual securities. They're more like an active analyst, you could say. And they're doing this because they are seeking better than average returns. They're trying to beat the market through selective opportunities.
So they're looking beyond just the big, stable companies.
Yeah, their focus is much more active, much broader. They might be digging into situations the defensive investor wouldn't touch, maybe looking at smaller companies, so-called small caps, or situations that are temporarily out of favor with the market for some reason, maybe complex businesses that most people don't understand and therefore might be mispriced.
But the big danger here, I imagine, for the enterprising type, is getting overconfident. Thinking that just because you're putting in the hours, you're automatically going to outperform.
That's exactly the trap. The absolutely critical constraint Graham placed on the enterprising investor is that they still must rigidly adhere to those fundamental principles we've been talking about.
Meaning margin of safety and thorough analysis.
Absolutely. They might be looking in riskier corners of the market, yes, but they have to compensate for that added risk with extreme discipline in their analysis and by demanding an even wider margin of safety sometimes. If an enterprising investor abandons those core ideas, forgets the margin of safety, skips the deep analysis, they instantly stop being an investor and become a speculator. Graham was really clear. Being active doesn't automatically make you smarter. Often it just means you're busier and potentially wrong more often.
Okay, that really ties the whole framework together. So we've covered the investment versus speculation distinction, Mr. Market, margin of safety, and these two investor types. What does this all boil down to for you, the listener, trying to navigate your own financial journey? Let's connect these dots into some final actionable takeaways.
Yeah, I think we can reinforce maybe 4 main principles here. These apply whether you see yourself as more defensive or more enterprising. They're universal in Graham's world. First, know yourself. This is huge. Your investment strategy has to genuinely fit your own personality, your risk tolerance, and crucially, the amount of time and effort you can realistically commit. Don't let ego push you into trying to be an enterprising investor if you just don't have the hours or, frankly, the emotional stomach for the detailed work and potential volatility.
Right, be honest with yourself.
Okay.
Second, think like a business owner. This is really the antidote to that speculative mindset we talked about. When you buy a stock, remember you're buying a small piece of an actual operating business, a business with employees, products, customers, revenue. Focus on its long-term prospects, its health, its management. Treat buying the stock like you're buying a part of that real enterprise, and try your best to ignore those daily, meaningless price wiggles from Mr. Market.
Makes sense. Treat it like a long-term partnership, not a lottery ticket. Third, insist on the margin of safety. This one's non-negotiable for Graham. It is your absolute best defense against all the uncertainties we discussed, mistakes in your analysis, unexpected events, market craziness. Always aim to buy significantly below what your careful analysis suggests the business is actually worth.
By value, not hype. Got it. And
finally, be patient and disciplined. This is maybe the hardest day to day. Investing intelligently is absolutely a marathon, not a sprint. Those sound principles, they compound wealth slowly, steadily, reliably over time. You have to resist the urge to chase fads, get spooked by scary headlines, or let Mr. Market's emotional outbursts dictate your actions. Discipline is key.
It really comes through that Graham's work isn't some kind of get-rich-quick scheme, is it? It's much more profound. It's a guide to building a sound, enduring investment philosophy, one based on value, discipline, and maybe above all, managing risk. These are principles that have guided some of the world's most successful investors for decades.
Absolutely. And maybe this raises an important final question for you, the listener, to think about. Connecting back to Graham's book, if his rules are actually pretty clear and the methods for valuing businesses are widely available, why do so many people still struggle and often fail quite spectacularly at investing? The answer, I think, lies less in the math and more in the mind. Maybe reflect on this. How much of true investment success really depends not on having some superior analytical gift or finding that one magic stock, but simply on consistently applying emotional discipline, on managing your own behavioral reactions to Mr. Market's constant noise and fluctuations. The intelligence Graham was really aiming for, perhaps, is less about IQ points and much more about that internal self-control, relentless self-control.